Bonds are a popular investment option for those seeking stable income and lower risk compared to stocks. Two of the most common types are Treasury bonds, T-bonds, and corporate bonds. While both are debt securities that pay interest over time, they differ in terms of issuer, risk, returns, and tax treatment. Let's break down both options and compare them across key factors. What are Treasury bonds? Treasury bonds, T-bonds, are long-term debt securities issued by the U.S. government. When investors buy a Treasury bond, they are essentially lending money to the U.S. government in exchange for regular interest payments, called coupon payments, until the bond matures. At maturity, the investor receives the full face value of the bond. Key features of Treasury bonds. Issued by the U.S. government, making them one of the safest investments. Fixed interest rate, with payments every 6 months. Long-term maturities, typically ranging from 10 to 30 years. Lower yields compared to corporate bonds, but almost risk-free. Tax benefits, exempt from state and local taxes, but subject to federal taxes. What are corporate bonds? Corporate bonds are debt securities issued by companies to raise capital. Investors who buy these bonds lend money to corporations, which promise to pay interest until the bond matures. Corporate bonds can vary significantly in terms of risk and return, depending on the company's financial health and credit rating. Key features of corporate bonds. Issued by private companies, meaning risk levels vary. Higher interest rates compared to Treasury bonds to compensate for risk. Different credit ratings, from investment grade, low risk, to junk bonds, high risk, high return. Maturities can range from a few years to decades. Taxable at federal, state, and local levels. Which one is better? Choose Treasury bonds if you want the safest possible investment with virtually no risk. You are comfortable with lower returns in exchange for security. You want to avoid state and local taxes on your bond income. You prefer a long-term, stable investment. Choose corporate bonds if you are looking for higher interest rates than Treasury bonds offer. You are willing to take on some credit risk for better returns. You want a variety of maturity options, short, medium, or long-term. You don't mind paying state and local taxes on your interest income. Conclusion. Treasury bonds and corporate bonds both serve different investment purposes. Treasury bonds are ideal for conservative investors who want long-term security, while corporate bonds offer higher yields with some added risk. For a balanced portfolio, many investors choose a mix of both to diversify their fixed income investments.